You could be putting everything at risk if you are not always prepared for an economic downturn. When there is a financial crisis, it is not uncommon for people to lose jobs that seemed stable at the time. Their retirement funds may be halved, and they may even lose their home to the bank. All of this could have lasting effects on health and on relationships. When the economy does well for a long time, it's easy to forget about bad times, but there is never a time when slowdowns should be reduced as much as possible. Fortunately, when an economic downturn occurs, it creates enormous opportunity for those with high level of financial stability. This can give them the opportunity to amass wealth far beyond their wildest dreams. Learn how to properly prepare for bad times so that you can take advantage of opportunities as they arise. A recession is when the economy slows down a lot and stays slow for more than a few months. This could be due to a number of things such as inflation, which happens when prices go up and the dollar gets weaker, deflation, which happens when prices go down and the dollar gets stronger, more high interest rates, and problems with lending. Most of the time, these problems lead to more people being unemployed, less consumer confidence, people losing their homes, and businesses going out of business. Because of these factors, the stock market typically falls as investors panic, lose confidence, and withdraw their funds from the market. At any time in the economic cycle, if you want to improve your finances, you should live below your means and spend less than you earn. The difference between your income and expenses is used to invest for the future and pay down debt. Unfortunately, though, a lot of people get stuck in a cycle of barely getting by because their expenses keep going up at the same rate as their income. When they get a raise, they use that money right away to buy a new car or a bigger house. When their tax return comes in, they've already spent it on a trip. When you hear the phrase "live below your means," you might think of words like boring or boring, but when you start to do this, your life will change in so many good ways. The average millionaire has 7 ways to make money. They don't depend on just one paycheck from their job to pay their mortgage, car payments, and other bills. So they don't have to worry about getting fired. When you have more than one source of income, you have less to worry about if one of them stops coming in. When you live below your means and have more than one source of income, you can still pay your bills if something bad happens. The chance that one of your regular income streams will take off is probably the best reason to have more than one way to make money. For example, someone with a 9-to-5 job might start doing detailing on nights and weekends. The business turns out to be a hit, with people waiting in line to get services. It ends up being a job that pays much more per hour than a 9-to-5 job. They can now quit their full-time jobs and focus on their detailing business, which pays them twice or 3 times as much as their main jobs. Debt repayment does not make sense in every situation. To put it in another way, it makes sense to pay off high-interest debt quickly while making minimum payments on low-interest debt. Instead of spending every extra dollar, you have to pay off low-interest loans as quickly as possible. You could invest that money to earn more interest than you're paying. Consider whether it would be better to invest extra money that could earn a 10% return rather than pay off debt with a 3% interest rate. Mathematically, this makes sense, but some people don't take into account the fact that your monthly needs will be very low if you have very little or no debt. Think about how much less you'll spend each month if you don't have a car payment, student loans, credit cards, or even a mortgage, compared to someone who is in so much debt that they are drowning. You'll sleep better and be better prepared for a recession and economic risks. How many purchases have you regretted? That brand new car that's dented, has frequent mechanical issues, and is worth almost nothing. What about that time you were sold on vacation, or the 300-person wedding you threw for your ex-spouse? It's fine to buy expensive things if they're important and make you happy. But it's bad to buy big and small things without thinking. Spending money on things you don't want days, weeks, or months later will drain your wallet. When you lose your job or your retirement savings halves in a market crash, these pointless, forgetful purchases will leave you wondering where all your money went. If you think twice before buying an expensive item or carefully consider whether or not you want to splurge, your future self will thank you. You'll also get more joy out of every dollar you spend if you don't buy something you'll forget about soon after. Will things ever return to normal after a recession or stock market crash? Acorns reports that recessions occur every 4 years and last about a year and a half. Every 3.5 years, stock drop at least 20% and last between 9 and 10 months, with an average stock market drop of 35%. The stock market drops an average of 35% every 3.5 years, but it recovers in less than a year. It's unsettling when your investments lose a lot of value, especially as you get older and replacing those funds seems impossible. That's your hard-earned cash that's practically vanishing into thin air. But when you look at history and know what to expect, these events are easier to stomach. Remembering that markets aren't always positive will encourage you to prepare your portfolio for setbacks and avoid anything you wouldn't want to own. Buying stocks on a margin seemed like a good idea when the economy was strong, but don't borrow more than you're comfortable with during all market cycles. What if things get worse? Are you over-leveraged? What about your home equity line, which allowed you to borrow against most of your home's value? If your income drops, how will you pay? Borrowing money can be profitable, but you must be careful not to over-leverage and consider each market cycle. Profit opportunities increase with market or economic decline. According to Warren Buffett, be fearful when others are greedy, and greedy when others are fearful. When assets reclaim their all-time highs, investors who bought them at a discount are often well rewarded. Buying the dip is a simple strategy that follows the basic investment principle of buying low, sell high. Timing the market is difficult, but buying stocks when prices drop sharply and holding onto them for a long time is simple. If you have extra cash to invest, a recession could be an opportunity. Recessions are easy to forget, especially for younger people who don't remember them. When the economy is thriving and appears to be unstoppable, the bad times become distant memories. Remembering these times and being prepared for them will put you in a much better position to withstand an income interruption, a significant loss in portfolio value, and even allow you to take advantage of incredible market value. Compare this to someone who is unprepared and expects nothing less than a perfect economy in constant uptrend with their investments, who may lose their home, face major problems in their family, and face a slew of other negative consequences. Please remember to subscribe to our channel and to hit the like button. Thanks!